In stocks, you can either buy or sell a stock to open. This is also referred to as going long and short. The same goes for options. You can either buy or sell them to open. You can either buy or sell a call option, and you can either buy or sell a put option. In stocks, selling is more or less exactly the opposite of buying a stock. If you short stock, you hope that the price will go down, and if you buy stock, you hope that the price will rise, and that's it. With options, things are a little different. Buying and selling actually are quite differently. It is very important to understand the differences between these two things to trade options profitable. In this video, I will break down all the differences. Let's start with the main differences between selling and buying options to open. Probably one of the biggest differences is that an option buyer will always have the right to exercise his option, and a seller will always have the obligation to accept this. More specifically, a buyer of a call option has the right to buy the underlying stock at a certain predetermined price. A seller, on the other hand, of a call option has the obligation to sell the underlying stock at a certain predetermined price. A buyer of a put option has the right to sell the underlying stock at a certain predetermined price. Last but not least, a seller of a put option has the obligation to buy the underlying stock at a certain predetermined price. In other words, a buyer of an option will always have a choice, and the seller will always have the obligation to deliver or accept shares at the strike price, if the option buyer exercises his option. But note that not all option buyers exercise their options. This means that just because you sell an option, you won't necessarily have to accept or deliver shares. This actually only happens rarely. Additionally, you can still always buy or sell your option positions. The next major difference is the payoff of a long option and a short option. Long calls and long puts will always be defined risk trades. This means that your risk is limited. You can only lose a certain amount of money. On the other hand, long options have an undefined upside, which means that you don't know how much money you will make because there's no limit. This is the same in stocks. Short calls and puts, however, are undefined risk, which means that you don't know how much money you can lose, as there is no limit. But short options do have a limited profit potential, meaning that you can't win more than a certain amount. Otherwise, there are many differences regarding the Greeks, but more on that later. Now I'll explain option selling and buying separately and more in depth. I will start with a small breakdown of buying options or going long. First of all, you can either buy a call option or a put option. Like I said earlier, both payoffs are defined risk and undefined profit. The only difference is that a long call option profits from a rise in the underlying price, and a long put option profits from a drop in the price. The further the price moves in that direction, the more profitable these long options will be. But typically, long options are first profitable when the underlying price moves in the correct direction. This makes long options directional. If the price of the underlying would stay the same, long options would lose their value and expire worthless. In addition to that, long options are opened for a debit, meaning that you have to pay to open a position. Lastly, another important factor for both options is that the option Greek theta, also known as time decay, does not work in favor of long options. This means that time is your worst enemy when buying options. The more time passes, the more value long option positions will lose, and the less time you will have for the underlying price to move in your direction. Time decay is not linear, so the closer the long option positions get to expiration, the more value they lose every day. Now let us move on to option selling. Here again, you can either sell a call option or sell a put option. This is how the payoff diagrams look for these two option positions. As you can see, and as I said before, the downside is unlimited and the upside is capped. So after a certain price, it does not matter how far the underlying price rises or falls. The position won't be more profitable than a set amount. And it is the other way around for the downside. The further the price moves against your position, the more money this position loses. Note that short options are suitable for different market assumptions than long options. First of all, a short call is more bearish than bullish, like the long call. The short put option is also bullish instead of bearish, like the long put. But overall, short option positions are neutral and range bound to slightly directional strategies. For a short option to not be profitable, the underlying price first has to move against it. In other words, if the underlying price stays like it is at the entry, the short option position should be profitable. This is the case because of the option Greek theta or time decay. Theta actually works in favor of short option positions, so only from time passing, short option positions gain some value. Again, this time decay is non-linear, meaning that the closer the option comes to expiration, the more value it will gain every day. All these features of long and short options don't only apply to naked call and put options. There are hundreds, if not thousands, of different option strategies out there. Most of them either are overall short option strategies or long option strategies. Therefore, the just mentioned points also hold true for these strategies, depending if they are long or short strategies. Here are some of the most popular and most effective long and short option strategies. First off are the overall long option strategies, and I will start with the long strangle. A long strangle consists of two long options, and just like other long strategies, it is defined risk and undefined profit. Furthermore, time decay works against a long strangle, and it is used for directional bets because it profits if the underlying price makes a big move in any direction. Next up is a long straddle. A long straddle is very similar to a long strangle and works very similar to it. The next long strategy is a long iron condor. This also consists of two long options, but it also contains two short options. Nevertheless, the long options are closer to the underlying trading price and thus more worth. Therefore, this strategy is an overall long strategy, and all the points, except for the undefined profit, also hold true for this strategy. Finally, we have a very simple spread, a debit spread. Debit spreads are made from one long option and one short option. Again, the long option is more worth, and all the points except for the undefined profit also count for this spread. Now let us move on to some short option strategies. As the first strategy, I chose a short iron condor. A short iron condor consists of the same options as the long iron condor. The difference is that the short options are closer to the trading price of the underlying this time, and therefore these are more worth than the long options. Therefore, time decay works in favor of this spread, and it is an overall neutral and range-bound strategy. Nevertheless, it is a defined risk trade because of the long options. Furthermore, we have a credit spread. Just like the name implies, credit spreads are similar to debit spreads, just that the credit spreads are opened for a credit and are overall short option strategies. But just like debit spreads, they are made of a short and a long option. Moreover, next to the long straddle, there also is something called a short straddle, which contains two short options. All the above mentioned points are true for this strategy. Last but not least, we have a short strangle, which is very similar to the short straddle. If you are interested in some of these strategies and want to learn more about them, My options trading site, tradeoptionswithme.com, does have a strategy section in which all of these strategies are presented much more thoroughly. A link is in the description below. You now already know much more about the differences of long and short options and option strategies. But what is the better? Should you rather sell or buy options? To help answer that question, I will sum some of the pros and cons of each up now. Let us start with the pros and cons of long options. A definite pro of option buying is that you will have the right to exercise. You do not rely on someone else and don't have any obligation. Another clear pro is that long option strategies mostly are defined risk and undefined profit. Some cons, on the other hand, are that long options almost always are directional strategies that give these trades a rather low probability of success. This is the case because the price of the underlying has to move before you make any money. Finally, a big con is that the time decay works against long option strategies. Pros of short strategies are that they are more versatile because the price does not have to move for them to be profitable. Therefore, short option strategies usually also have a high probability of success. Additionally, the option Greek theta, or time decay, works in favor of short option strategies, which is a big plus. On the other hand, a con is that an option seller does not have the right, but has the obligation to accept or deliver shares of the underlying if the option buyer chooses to exercise his option. In addition to that, naked and short options are undefined risk, and all short option strategies are defined profit strategies. Before we move on to a conclusion, let me touch a subject that we haven't heard too much about up until now: the Greeks and their impact on short and long options. You may recognize this table from a former video about option pricing. This table displays the impact of the different option Greeks on different option positions. Not all of these are relevant for the differences between short and long options, but some definitely are. The relevant ones are vega, theta, and gamma. Vega shows the impact of volatility. A positive vega means that a position profits from a rise in implied volatility, and a negative vega symbolizes that this position profits from a drop in implied volatility. So as visible on the chart, long positions profit from a rise in implied volatility, and short positions profit from a drop. Therefore, it is better to trade long strategies in times of low volatility and short strategies in times of high volatility. Theta is the next and probably most important Greek that is relevant. Theta is the same as time decay, and I think I mentioned this often enough. But once more, long positions lose some value every day and short options gain some value every day. Gamma measures the rate of change of delta. Delta measures the change in the option's price for a $1 move in the underlying. Long positions have a positive gamma, meaning that gamma works in their favor. For every $1 move in the underlying, long positions gain more and more value. As an example, let's say a $10 option profits $0.5 after the first move and then profits $0.6 after the next $1 move, and so on. If the price moves down by $1, the same $10 option loses $0.5, but for the next $1 move, the option only loses $0.4. Summed up, long options gain more and more value and lose less and less value for moves in the underlying. The whole thing is the other way around for short options. So short positions lose more and more and gain less and less for every $1 move in the underlying. So let us finally come to a conclusion and sum things up. The question of what is better can't be answered easily. This is because it really depends on many things. It depends on your trading style, the market environment, your portfolio, and more. But usually, if you want to have a defined risk trade that can be used as a hedge or want to profit from directional bets, long options are a better choice. Short options are great if you want to profit from time passing by and don't want to predict any seemingly unpredictable prices. Generally, it is safe to say that most options actually expire worthless, and very many people make money from this by selling options, including me. But this does not mean that buying options is bad. In low volatility times and for portfolio diversification, even I would buy options. If you want to learn more about options and how I make my money with them, visit tradeoptionswithme.com. But for now, thanks so much for watching and have a wonderful day.